To understand real-world assets on-chain, we first need to see how traditional finance structures them. Over decades, TradFi has learned how to turn messy loans and receivables into clean, investable products. Crypto is now rebuilding that plumbing on-chain, sometimes repeating old mistakes, sometimes improving on them. In practice, investors almost never finance a single loan at scale. An originator, like a fintech lender, repeatedly creates similar assets, loans, invoices, or receivables. Rather than sell each one individually, they bundle them into a pool with shared traits: credit quality, term, collateral, and so on. That pooling step is foundational. It diversifies away idiosyncratic risk, standardizes how risks and cash flows are measured, and turns messy individual deals into investable, institutional-grade products. Once you have a pool, tranching is how you carve it into different risk and return buckets. At the bottom are senior investors. They want safety, so they get paid first, accept lower yield, and only take losses if everything above them is wiped out. In the middle, mezzanine investors accept more risk for more yield, with intermediate protection. At the top, equity or junior investors are the shock absorbers. They're paid last, lose money first, and demand the highest potential upside. Securitization is asset risk in a box. The originator sells a pool of loans or receivables into a separate legal vehicle, the SPV. That SPV is designed to be bankruptcy-remote. If the originator blows up, its creditors can't grab the pool. Investors don't own the loans themselves. They hold securities that claim a share of the cash flows the pool generates. This separation of assets from corporate risk is the core mechanic RWA protocols are copying on-chain. Collateral is what stands behind a deal when things go wrong. It's the asset or legal claim a lender can rely on, like a warehouse, machinery, or a pool of invoices. Institutions care about three things: what they can actually seize, how quickly they can sell it, and what it's worth in a crisis. Better, more certain collateral means cheaper funding and more flexible terms. When we talk about credit and risk assessment for RWAs, we're really asking three things. First, at the borrower level, can this specific party pay us back based on their income, collateral, and history? Second, at the portfolio level, how concentrated are we in any sector, region, or vintage? And third, under stress, what happens if defaults spike or funding costs jump? Covenants are the rule book that keeps investors protected. They're pre-agreed conditions that say, as long as you behave like this, money can keep flowing on these terms. If those conditions are broken, costs go up, controls get tighter, or the structure can be shut down and unwound. In RWA deals, covenants are the primary tool for controlling behavior and risk. You can think of the SPV as a legal vault that separates the assets from the operating company. The originator moves specific loans or receivables into this new entity. If the originator goes bankrupt, creditors can go after the company, but not the assets locked in the SPV. Investors then hold claims directly on that protected pool, not on the originator itself. On-chain, the closest analogy is a dedicated smart contract vault that only holds a defined asset pool and issues claims against it. Now zoom in on how that vault actually runs. The SPV sits in the middle, and a set of parties form the operational backbone around it. The servicer is the front line. It talks to borrowers, collects cash, and chases late payments or recoveries. A backup servicer is lined up so cash flows don't stop if the primary fails. The custodian protects the collateral and records so nothing disappears. And the trustee is the investor's lawyer and referee, making sure documents are followed and enforcing rights when things go wrong. A payment waterfall is the rule book for who gets paid and in what order, every time cash comes in. First, money is skimmed for fees and expenses. Then senior investors get their interest, then their principal. Only after that do mezzanine and finally equity investors receive whatever is left. If performance deteriorates, rules can automatically redirect cash away from junior tranches to protect seniors. Equity and reserve layers sit at the bottom, taking the first loss. With that context, we can translate TradFi structures into DeFi RWAs. The SPV that legally holds assets maps to an on-chain vault or credit pool, usually backed by some wrapper entity. The trustee or agent role is mirrored by protocol governance, token holders, multi-sigs, or a DAO enforcing rules. The servicer or originator becomes an off-chain asset manager pushing data on-chain, and covenants plus the cash flow waterfall are encoded as smart contract parameters and routing logic. Traditional structures optimize for legal certainty but accept slow, opaque processes. Reports arrive as PDFs, data is keyed in by hand, and enforcement waits on courts and trustees. On-chain RWA designs flip that. They prioritize real-time transparency and automated execution. Cash flows, balances, and covenant tests can be visible and programmable, but only if Oracle data is reliable. Governance also shifts from bank arrangers to DAOs or multisigs, trading speed and expertise for openness and community control. As a crypto builder in RWAs, approach design like an institution. Assets flow into a pool, then into a legal wrapper, then into tranches and a waterfall for investors. Always ask who holds collateral, who services it, and who can enforce. Encode covenants in code. And never forget, on-chain terms must mirror off-chain documents exactly. To use these prompts well, pick one concrete asset pool or protocol and stick with it. First, name the human institutions behind it. Who originates deals, who legally owns the assets, who services them, who represents investors. Then decide how losses and upside are sliced across token types. Next, turn the most important covenants and triggers into code, not PDFs. Finally, be honest about what still depends on off-chain trust, and design explicit safeguards around those weak spots.